Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by senior technical strategist Todd Sohn. Todd, how are you doing today?
Hey, Ross, I'm great as always, and nice to speak with you.
Good to talk to you as well. We're going to do a bit of a grab bag today, bounce around some sectors, some international markets. But I want to start with, we got this jobs data at the end of last week that was pretty sour. It kind of sparked a bit of a growth scare in the U.S. economy. And we've heard a lot about the US consumer being stretched. And I want to know, from your perspective, looking at the consumer stocks, what do they say about the consumer story at this point in time?
Yes, great question. The jobs data was a little shake up on that one day. We've been able to recover a little bit since, but the important message is that consumer discretionary stocks are still holding in there. Relative to the S&P, you're at a 5-month high on an equally weighted basis, and you're still also pretty firm in trend against the consumer staples. And what I find interesting is as you've had rates come off the boil here, start to drip towards that lower end of the 4% range, you're getting some signs of life from areas like the home builders. The home builders have been off the field for quite some time. The data there has been dire, right, for what that's worth, but you are seeing bottoms occur for home building stocks. That's supportive for consumer discretionary. And then some other changes at the margin. You're seeing names in the food ecosystem space, right? Reservations, delivery, payments are still hanging in there. Yes, some of the old consumer stalwarts have had their own structural problems, but I think you're seeing that taken up by some of the more newer consumer discretionary stocks there. And so that's very supportive. Until those relationships change, right? The relative profile of discretionary, I think this sector continues to look past the economic data, and we're okay with that.
And that's important because the economic data often gets the big headlines, but the stocks underneath the surface are quietly working higher. On the flip side of that, a sector that you recently did some work on, I want to get your take on the energy sector. It had a great run, in 2021, 2022 when oil prices spiked and we had all this inflation scare, but it has struggled in the bull market that has been going since then. What do you see from energy? What could spark a revival? What should people know who are looking at the energy sector?
Yeah, it's been a tough go the last few years. Energy has been all about opportunity cost for us, right? As much as some of these charts have these massive big ranges where you can get really good technical breakouts, the waiting game is the problem. Meanwhile, you have discretionary and tech, right, setting the tone. So the one part about energy I think that is supportive is when you look at energy sector ETF flows, there's been this mass exodus out of energy sector ETFs. So if you can get some momentum back into the sector, maybe it takes a little bit of an inflation scare or oil to pop a little bit more. The sentiment is so dour on that space that that's going to be a major asset to drive those names forward. But I think in the meantime, it's just more of a waiting game. Perhaps you can play through options, right, of using some calls so you're limiting your capital risk involved with playing the energy sector. There are some select opportunities in global ADRs. We'll see if the gas names can respond to oversold conditions, even though natural gas has deteriorated. But in the meantime, I'm still very much lukewarm. It's opportunity cost. Yes, there's supportive sentiment, but I think there's better opportunities elsewhere in that cyclical camp outside of the energy space.
So speaking of an area where investors kind of threw in the towel, sentiment got dour, and then the stocks turned and investors are kind of trying to catch up. International, right? We had this big start to the year for international. Dollar was down, and it's kind of quietly persisted as strength. We've had this kind of global breadth story. What are you seeing abroad? Does that story have legs to you? And then are there any pockets of international that are of particular interest to you right now?
Yeah, we do think it has legs. We do think international is here to stay and to continue to work. Of course, there's going to be ebb and flow, right? We think Europe is consolidating, correcting in some cases. But meanwhile, you have stuff like Japan is starting to reaccelerate. And Japan is a very consumer and industrial heavy market. So we like what's going on there if you want to add exposure. And then I would also focus on Canada. Don't forget about Canada, our northern neighbors. I think that gets a little bit overlooked in the international geography. And if you look at the makeup of Canada, it's very value-oriented. So we have a growth-heavy market here in the U.S. If you're just looking to diversify and add some more value tilt, Canada's a great allocation. The bank stocks there work well as they are in the U.S. Gold mining stocks are big in Canada. Those are starting to reaccelerate. And there's a little bit of technology there that is working within Canadian stocks. And so it's one of the markets that really hasn't stopped rising despite some of the tariff headlines that are out there. So this is one of those cases where don't put all your eggs in listening to what the headlines say, because you're probably going to get scared away of a really good opportunity. Yes, Canadian equities are a little bit overbought in the near term, but we think they are worth adding to our portfolio, especially if you're looking for global diversification on any weakness over the next 1 to 2 months, let's call it.
So fade the headlines, watch the stocks, consumer discretionary, Canada, international. This is all great stuff, Todd. Thank you so much for the time as always, and we'll look forward to talking to you again soon.
Same to you, Ross. Thanks a lot.